Hello, everyone. Today on the Final Bar, my guest is Samantha LaDuc from LaDuc Trading. We're going to talk about growth versus value, relationship to interest rates, sort of this big picture theme. Market once again in distribution mode, with a lot of it happening in the last hour, similar to what we saw yesterday. And a lot of days in the last couple of weeks, really showing some distribution, showing some negative sentiment going into the close. The Nasdaq finishing down almost 2%. The Dow finishing just above flat. We'll see how the closing ticks play out. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in rainy Redmond, Washington. Thanks for joining us every weekday after the close as we make sense of these markets, or attempt to do so using the power of data visualization, charting, technical analysis, investor sentiment, psychology, everything we can do to try to make sense of things. As I mentioned in the introduction, certainly some distribution going into the close here. Not a ton of surprise in my opinion, just given a lot of the distributed patterns that we've seen. On my own YouTube channel, I just posted a video this morning talking about the bearish divergences that are abounding in the financial sector. The XLF making a higher high recently with lower peaks in momentum. That is not usually the sign of the beginning of much further upside. That's more the sign of toward the end of the bull market phase as an uptrend is exhausted. You're continuing to see small caps rotate lower, and I think if there's maybe one thing that really speaks to the weakness of sectors and where the opportunities are eroding, I think the small cap sell-off that's continued again today probably pounds that story home even more. We have some great guests on this show. I'm super appreciative for some of the conversations we had. Had a lot of fun with Mark Newton yesterday. We have Samantha LaDuc today. I'm excited to get her take on the big picture environment. Tomorrow on the 25th, we have Doug Bush from Chart Smarter in New York. Next week on Tuesday, the 30th, David Auerbach from the Daily Repeat. On Wednesday, the 31st, JC O'Hara, the technical analyst at MKM Partners. Then on Thursday, April 1st, we have Matt Tuttle. Matt's the founder of Tuttle Tactical, who is unleashing ETFs like the SPAC ETF, the FOMO ETF, and others. So that should be a lot of fun. Also, there's a thing called a vacation, which I am told people take, and I'm very excited to be taking one in a couple weeks, the week of April 5th. And the reason why I'm mentioning it is because we've invited some guests to host the show every day during the week. So people like Aaron Swenlin, Greg Schnell, some really capable technical analysts, contributors on StockCharts have agreed to step in for one day at a time and wrap the day for you on the Final Bar. So look forward to that the week of April 5th. Let's continue on with our market recap. As I mentioned, the acceleration to the downside into the close is pushing everything lower. Just since we started recording the intro, the Dow looks like it's printing at just below zero. It's essentially flat from yesterday, but it had been up for much of the day. The same with the S&P 500, which ended up closing down about 0.5%. Back below 3,900 into the close. The Nasdaq really pushing its way lower with the Nasdaq Composite down over 2%. Mid caps and small caps, though, also down. And small caps the most, with the S&P 600 down almost 2%. So, continuing to see a broad distribution in the small cap space. Part of that is a sector, story, but it's also just the general, I would argue, sort of a risk-off feel with people rotating out of small caps. The VIX back above 21. Around 2140. Very quickly with the other markets, 10-year yields lower, nearing 160 again, with bond prices bouncing up, the dollar up about a quarter of a percent, which is putting that uptrend that we've seen in the dollar. We're going to look at that in a bit, but certainly putting pressure on global markets with things like China, Japan really coming off in the last couple days to a week. Gold prices bouncing up a little bit, silver just above flat, but commodities as a whole up, with oil prices moving higher. And energy was really the bright spot in the markets today, up 2.5% on the XLE. But industrials materials up a decent amount relative to others. The real laggards were communication services, consumer discretionary, technology, the FANG sectors, if we'd like to call them that. Crypto's actually mixed, and there was a lot of distribution going into the close. Ethereum had been up and ended up closing down very quickly. It was a huge swing in the last hour before we hit play on the show, and Bitcoin about 0.25% up from yesterday, but coming off very, very aggressively. Let's look at a chart of the S&P 500. So again, putting a day like this into proper context, take a step back, look at the last year of trading, and again, what's speaks to me, two things on this chart as we've talked about it recently. The two things that jump out at me: number one, we've continued to make higher highs and higher lows. So just a week ago, we made new all-time highs on the S&P. So we're a week off from making new 52-week new all-time highs, nearing 4,000 on a closing basis. Also, and I think what's even more meaningful for right now is when we've pulled back, we've continued overall to make higher lows. Look at the low every month in December. They're in late January. February was sort of a rollover into the March low, but you can see each of those major pullbacks continuing to be higher. We're not undercutting the previous low. So we've had a couple of scares where the price has gone down and we've held those lows. I think the signal to be looking for is when that pattern changes. Step one, do we get below the 50-day moving average? That did not happen today. Certainly could happen through the remainder of this week. That would be step one. We've done that a couple times, traded below it in January, closed below it in March, but both of those times the market quickly reverted back to the upside. So step one, do we get through the 50-day moving average? Step two, do we close below it? Step three, do we follow through the next day? And those three steps have not happened since last fall. So if and when that does happen, I'm immediately looking at 3,700 as really the key support level we've talked about for a while. If that breaks, I think you really need to think about further downside potential. At this point, this could be just a normal move within a long-term uptrend. And in general, I tend to think of it that way. What concerns me are the bearish divergences. We'll spend a minute talking about that. Here's the bearish divergence you have in the S&P 500, which with every high, we've made new highs every month in 2021, and every single one of those has been met with a lower momentum reading. So, the RSI has failed to eclipse its previous peak or the level it reached on the last upswing. That doesn't tend to be what sustained bull market moves are made of. There you want strong and sustained momentum as the prices are going higher. Here we're actually getting waning momentum, which is a little more negative. We'll come back to Viacom, which is one of the uglier charts today, but I'll show you here. Semiconductors in January and February making a higher high, lower peaks in RSI, and we can see how it's then made a new low, has bounced back up to the 50-day, rolling over again today. I'm concerned about further downside there. Now compare that chart to what you see on a chart like JP Morgan or the financial sector, the XLF, and you see kind of what semiconductors look like about a month ago, where you have higher highs in price and lower peaks in the RSI. So I'm seeing a lot of charts with this sort of momentum divergence, including one we just talked about very briefly, chart of Bitcoin, where you see higher highs in price and lower peaks in momentum. I'll zoom out a year so you can see what I'm talking about. But here you can see the higher highs in price in the last month. Here we can see the lower peaks in momentum. That's actually continued from January. So both the S&P and Bitcoin are showing this long-term bearish divergence. Now, of course, with Bitcoin, you've gone from 42,000 to 62,000 over that 2-month period. That's quite a pop. That's a 20-25% rise over that stretch. And granted, these are huge percent swings. However, I have to trust the momentum reading that I'm seeing. And this in particular, with higher highs over the last month and lower peaks in RSI, I'm seeing that essentially across the board. You're seeing that a lot of places. Now, where you are not seeing that bearish divergence, but perhaps something a little more different, will be something like bond prices. So this is the TLT, the long bond ETF. We can see lower lows in the price from February to March, and you look at the bullish divergence, higher highs in price from February to March. So we're seeing this bounce in bond prices, this pullback in rates. We're seeing a lot of stocks rolling over, and I would argue that that is a very reasonable byproduct or after effect of the run that we've had up until now. A steep sell-off in bonds, and that downtrend will not go to zero. It won't go down forever. You need to have a bounce, and arguably at the very least, this is a tactical bounce in bond prices, a tactical pullback in bond yields after an exceptional run up to the 170-ish level. Also, you're getting a lot of bearish divergences on the prices of or on the charts of stocks, so things like the S&P, semiconductors a month ago. And again, the growth trade already sort of rolled over. And I would argue now there's going to be choppiness in more of the value names. So again, the year that I've talked about as a model or as a general playbook for 2021, I would argue is 2010, because 2009 and 2020 were very similar, with a major bottom in the first quarter, and then a nice rally through the remainder of the year. Now, again, very different scenarios otherwise, but price-wise, those were very similar chart patterns. And if you look at 2010, it was sort of a choppy sideways year, more of a broadening year. And you made new highs and new lows during the course of the year, but in the end, you finished positive and things improved in the fall. When you think about reopenings and how the economy could get started, and it's all about, do we get too far ahead of our skis, as Mark Newton put it yesterday, on the way between here and there. Just to finish off here, I did want to mention, so two of the top ranked stocks in our Scooter rankings for a while have been Viacom, CBS, VIAC, and Discovery, DISCA. Both of them have gotten absolutely clobbered in the last 48 hours. And Viacom, particularly today, closed down around 23%, it looks like, right around 70. This is because of a secondary offering that they put out that is essentially diluting the shares a bit. And so the price is reasonably coming down as part of that overall structural change. What's interesting about a chart like this, and what's challenging about a chart like this, is even with a 23% loss today, it's still arguably on a long-term basis feels like it's making higher highs and higher lows. Now, arguably, if you take the low 85, which was the swing low from about a week and a half ago, totally fair, we broke down through that, but we're not even touching the 50-day moving average, which is another 5 points below where we're at now. We're not touching the most recent major low, if you can call it that, which would be around $60, which is the end of February, maybe back to 50.48 or so, which was the end of January. So the challenge with these really extended exponential rises is you can give back a lot and still not be touching some of the stops that you may normally think about. I think that's the danger of some of these extended names. The Scooter ranking of Viacom has come down from one of the top ranked stocks, if not the very top, down to 98.5, which is still pretty good. And overall, I think the question is tomorrow through the remainder of the week, what happens next? And I would be keeping a very close eye on the 50-day moving average. We need to take a break. We'll be back with Samantha LaDuc. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close for our show as we break down the technical themes of the day. As a reminder, we'll do another mailbag segment on Friday's show. We'd love to answer one of your questions on the air. Shoot us an email with what you're running into as you analyze your own charts. The Final Bar at StockCharts.com is our email. We're on Twitter at FinalBarSCTV. On our YouTube channel, you can go to below the video you're watching, just put a comment in with your question. Love to answer one of your questions on Friday's show. Also, as a reminder, the new StockCharts TV on demand website and app are all released, and they are fantastic, really well done. I'm proud of our team, of the content that we're able to put out, and our hosts with all of their great expertise. Go to StockChartsTV.com to set up a free account with your email. Also, you can go to all the app stores, search for StockCharts TV on demand. I want to welcome on my guest, Samantha LaDuc. Samantha is a frequent guest on the Final Bar, always brings a good big picture perspective to help us make sense in uncertain times. Samantha, welcome back to the show.
Hey, thanks so much. I'm really glad to be back because we get to kind of do this quarterly review of last calls, and this is timely. We get to revisit one.
There's a lot happening right now, and certainly feels rotational overall. We're starting with growth versus value. Give us a sense of how you're seeing things right now.
Okay, well, first I got to go backwards before I go forwards. The last time I did this Final Bar with you actually was August 20th. And it was right after I had made a call with clients, and I had also done a public post, which was I short gold and bonds. And the theme was, and this was basically beginning of August, that it was time for bonds, bond bubble, if you will, some of the froth to come out, gold to come down. And since then, they are obviously, gold really corrected more in time than price, but bonds had their biggest peak to trough sell-off ever. So, and it's still not done. Right now, what we're having, I believe, is a bond bounce, which is very much because of end of month quarterly rebalancing by pension funds, which also, by the way, is a decade big rebalancing. So out of equities and into bonds. So I fully expect a bond bounce, which we're getting, but then watch out come April. So I do not think the bond lows are in, and I'm talking specifically TLT as an example, but this was also a theme that I revisited when I was graciously invited back first of the year for the 2021 StockCharts TV predictions. And my number one theme was small caps over medium, medium over large. And all this growth to value chart really emphasizes is that rotation from growth into value, meaning that value would outperform growth, that large cap would stall. And it really did. September 4th was the top. And if you look at a lot of the big tech plays, you'll see a lot of sideways for the past 6 months, while small caps have been hot fire flames, right? Not just the Biden bid into the election, the blue wave, all the stimulus expectation, not to mention the Pfizer vaccine announcement November 9th. And then energy just took off strongly November through, and then especially January, February, that has now led. So last year, energy was the laggard, right? The bottom of the pile as it relates to sectors with poorest return. And tech was, of course, number one. This year, it's energy. So they have risen, and now we're in digestion period the past month, obviously post FOMC, when we have this rotation, I believe, quarter end with rebalancing, we have a definite change of sentiment as it relates to the growth plays. They are in trouble. Those who are holding the growth plays, are they going to recover? Are they taking profits in advance of, capital gains and harvesting, if you will? Before tax deadline, or fear of increased taxes. But long story short, the theme that I had last August when we talked, that bonds would go down with gold and this growth to value rotation would kick in, which means value would outperform growth, has absolutely transpired. And then the first of the year with the predictions, they were going to be very strong. They have been. Now I look at this bottom panel where it's yellow highlighted. This is an indicator, but it's basically telling me it's not done. And the mountain, if you look where the yellow arrow is pointing down, this is a very large mountain to climb down. So I think this is still going to outperform growth over versus value is going to be challenged. I think it's going to have a tough time.
So as you think, Samantha, about this, the coming months, and, obviously a lot of these names have had exceptional runs, right? Energy stocks have rallied beautifully. Banks, regional banks have done incredibly well on rising rates. So the movement that we're seeing in, this week, where we're seeing the rotation lower, we're seeing things be under pressure. This, to you, am I right in saying this is more of a short-term rotation of sorts, and then it's back to value over growth and continue to lean into those value areas, things like financials, industrials, or how would you think of it differently?
So financials, I'm a little bit more suspect of, I will tell you right now, industrials and boring old tech, and definitely I think energy will have a resurgence, especially going into the summer months. We're going to continue to have rising CPI. May's report for April will show strength. June's report for May will show strength. So I still think the energy sector is going to perform, again, relatively outperform a lot of the growth stuff. And I think a lot of new traders who came in last year don't realize is that their high flying ARC, components, or ARC ETF itself is a duration trade. And as the long end has continued to rise yields, and you can show that next chart, it isn't just higher yields, but take a look at that rate of change. If you put your green circle around that yellow arrow, that's a 100% rate of change increase. This has never happened in the history of the 20-year. I can show you the same thing with the 5-year, and look at the head and shoulders underneath, which I was showing clients. last year saying, ooh, we're in trouble. This is a new interest rate regime. So with that, tech is a duration trade, and they don't understand that. So I would definitely err on the side of value investing. There will always be select stock picking within the tech space, but you can see what's happened with the SPACs. And I think Bitcoin right now is also going to have some issues with a rising dollar. And I think treasuries are having a tough time fighting this inflation. So it's going to now be the baton passed over to a rising dollar to help fight inflation. But we have it. We have inflation. We're going to have higher yields and that relative strength with value. Although the easy money has been made, I still see it as outperforming growth.
Samantha, we'll have to leave it there. It's such a great perspective. Appreciate you sharing some big picture thoughts. So much going on, and you really helped to cut through a lot of that noise. Samantha LaDuc, thanks for joining us. Be well. Talk to you soon.
Thank you so much.
That's Samantha LaDuc, founder of LaDuc Trading, and I love what this last chart as we were looking at it. I'm taken back to when we. I was at the Fidelity chart, and we always joked when we would have to take a paper chart off the wall to reprint it because the vertical axis got skewed so much because of an extreme move. There was a signal in that, and the extreme rise that you've seen in the rate of change of the on the long end of the Treasury curve certainly fits the bill. It's a great take from Samantha LaDuc there. We need to continue on. Our next segment is called Compare and Contrast. Something we like to do occasionally where we take two stocks. Similar, could be a little different as a way to, sort of A/B the two of them or relate them. The inspiration for this particular segment, by the way, was our Chart Madness special, which showed on Monday on StockCharts TV. If you missed it, go to stockchartstv.com, or you can go to our YouTube channel and watch it. It was a lot of fun. Grayson Rose, Greg Schnell, Tom Boley were great sports. We all shared our bracket of 16 stocks and picked our proposed champion. And one of the matchups we did in the first round, I'm sharing with you my take on it today. We're looking at Microsoft versus Zoom, and this was essentially sort of the old tech versus new tech discussion, right? An established technology company, more of a value-y technology company, if you will, and then Zoom, more of a recent high-flying name. When I'm looking at the two charts here, and the way I'm doing this, by the way, is using the gallery view. If you go to the top of StockCharts, change where it says sharp chart and go to gallery view and just type one ticker, a comma, and the second ticker. It will line the two of them up. It's a beautiful way to compare these, to compare two different stocks and make sense of them. My charts may look a little different than yours, by the way, and there's a message just below where you enter the tickers that'll tell you how to change your own charts and make them look however you want. When I'm looking at the daily view, you can really see the stark contrast between these two stocks, and it's relevant, or it's obvious, I think, when you look at the prices themselves. When you look at Microsoft making a new high in February, when you see a Zoom that made its most recent long-term high in October of last year. It literally has been in a downtrend since October of last year. Microsoft, along with others, has been in more of a consistent uptrend. The most recent pattern I'm seeing with Microsoft is a peak in September, a breakout out of that base here at the end of January, pulling back and essentially retesting the 50-day and retesting that breakout range, and now rotating back higher. And while it's pulled back today among most stocks which did so, overall the trend, I think the path of least resistance is higher, well above its 200-day moving average, and at this point remaining above its 50-day. It's pulled back a number of times, but it's been repelled every time it's tried to break down. Compare that to what you see with Zoom, with a pattern of lower highs, lower lows, most recently breaking down through support and breaking down through its 200-day moving average. If you flip the chart of Microsoft over, it almost looks like the chart of Zoom, in particular, where it's breaking out of the resistance level and pulling back. You can see here it's breaking down through the support level and now bouncing back and testing that from below, now rotating back lower. The second thing that comes to mind are the RSI ranges. Do you see how Microsoft, the RSI, has not gotten below 40 for the last year? This is during an established uptrend. Look at the same thing on Zoom, and you can see that starting in November, the RSI has consistently gone below 40. It's become oversold a number of times. And while oversold a lot of times means a viable bounce, that usually is more of a tactical signal. The long-term trend is more about the range of the RSI. Overall, it's remained more in a bearish range below 50 than a bullish range above 40. And that's one of the big contrasts I see between these two. That contrast, that differentiation between those two trends, by the way, really comes out on the weekly chart. And obviously, Zoom has not been around nearly as long as a Microsoft, so it doesn't have the benefit of this nice long-term uptrend where you can see the appreciation in Microsoft, but it does show you the last, really 6 months or so, the difference between a stock in a continued uptrend and a stock rotating lower. So, what's interesting about I should point out the point and figure chart, by the way. Most recently, Microsoft actually had a double top breakout. This is using our log scale point and figure chart, which is sort of the go-to point and figure chart that I would look. The column of X's above its previous column in an uptrend, staying above the 45-degree line is pretty good. Zoom is actually nearing a triple bottom pattern, which is a very negative signal where we break down. It's similar to what you saw back here a couple columns ago. So overall, when I look at the two of these, I see a chart that is working, that the long-term trend is positive, and I see a trend that is not working. So when I had to pick these two, I picked Microsoft. 3 out of the 4 of us on the Chart Madness special voted the same way. One lone outlier voted for Zoom. I'll let you guess which Tom Bowley that was. If you go to the Chart Madness special on our YouTube channel or on StockChartsTV.com, you can see that pick among all the others, and see how we filled out our bracket and which stocks we picked as the top of the heap of those 16 stocks. So that is our segment, compare and contrast. Again, the gallery view on stock charts, 2 tickers separated by a comma, is a really good way to compare and contrast. Let's finish off the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is Bitcoin. I got one little pick from Samantha at the end of her segment mentioning about Bitcoin, and I have to agree. I think the long-term trend in Bitcoin overall is very constructive. I think the upside potential on Bitcoin and going north of 100,000 is certainly possible, if not likely, down the road. I do see some signs of short-term weakness, and for me, the question I think for a lot of long-term investors is what is Bitcoin? At times I've heard Bitcoin is going to be a safe haven like gold. It's going to behave more like the dollar. It's going to behave more like risk on, risk off. And I think the jury overall is still out. What I'm seeing with Bitcoin is I'm seeing a lot of relationship of the price of Bitcoin versus more risk on versus risk off. It's really, it's a measure of speculation, because I would argue that's a lot of the driving force in the uptrend that we've seen. So overall, when I see a bearish divergence like I do here, I'm concerned about the potential move to downside. I think, if we start to break down through the 50-day 42,000 to 43,000 is a really interesting point. That's the peak from January. That's the low from the end of February. I think that's a really interesting rotation point to keep an eye on. I'll probably update some of these Fibonacci levels as well if we can get a little bit more of a breakdown. Chart number 2 is China. We're using the MCHI. There are a couple liquid China ETFs that people use. This is one I wanted to point out because Chinese markets overall over the last month have rotated lower. Although the ETFs that I just mentioned are now in a short-term downtrend of lower highs and lower lows. The move today brings the MCHI down to the 38.2% retracement of the March low of last year to the February peak from about just over a month ago. So we've retraced that first Fibonacci level, which also puts us down to this congestion area from the end of last year. We're right near the 200-day moving average. So I would argue we're at sort of a really interesting tactical point. It would be very reasonable to expect a bounce higher off of these this sort of congestion zone as the China ETF becomes oversold. However, what concerns me more is this pattern of lower highs and lower lows, and I'm concerned with a stronger dollar, which certainly seems to be continuing. That may be, we may see weaker emerging markets even more than what we've seen. And that takes us to chart number 3, which is the dollar index. $USD is our long-term dollar index. You can also do UUP for the dollar ETF. I'm seeing a pattern of higher highs and higher lows. We rotated higher again this week. We are nearing the 200-day moving average. From below, I think a break above there clears the way to 94 to 95, which would put us in the range from last fall. Folks, that is our show for today. Thanks so much for joining us every weekday after the close for the final bar. A special thank you to Samantha LaDuc from LaDuc Trading, bringing some charts, sharing her perspective about big picture events and long-term rotations. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.